Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your hosts, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day. All right, team, let's get it started. Let's do a little bit of a rundown here. Of course, mine's a little bit different than Joel's, but I'll do my best here. We'll talk really quickly about the SPY. You can see the SPY. Essentially, I mean, looks like we're getting hit right now, but getting a little bit of some down action right now. We were up there towards around the 398.50 area. We'll look to see if we come back to Friday's closing price. Friday's closing price being 396.40s on the SPY. And will we get back into the 400 handle? I think that's what everyone's going to be looking at on the daily. Can we get back to that 400? You can take a look at the TLT. TLT does not look good ever since we started breaking down this pattern, right? I mean, you guys can see that pattern right there. Started breaking that down. We haven't come back in the TLT. We'll look to see if we get some bounce in the bonds. Also wanted to bring in today, take a look at some WTI. This is a little bit different chart, of course. We'll take a look there. We're starting to see a lot of bottoming action around the 72 level. I think we really need to watch to see if we get crude oil to get back into the 70. If it gets back to 70, I think we can actually crack 70, go into the 60s. But if we get back above 80s, that also could put pressure towards 82, giving us a spike towards the 90s. So keep watch on crude. I think that's definitely going to make a big difference if we're going to see inflation spike even higher. When we talk about the US dollar, we can see how the US dollar has been running as of late. Got to a high there towards around 114, 115. And that was, of course, right before the turnaround that we had. We came back down towards about 100, bounced off of this kind of support. Now we're starting to come back. Will we get back there towards the 110? Keep watch on the dollar. I think that's definitely going to have an effect. And of course, it could be whichever one, wherever you're looking, leading, you know, when the market comes down, dollar starts coming back up, something to keep watch, of course. And the last kind of chart that I wanted to just kind of show, just overall kind of pointing towards the VIX starting to kind of just balance out here around the 21, 22 level. Will we get a spike that comes back towards the 24 is something to keep in mind. All right, that's enough for these charts. I'm going to go ahead and bring them down. We'll go back towards the SPY and, of course, bring on Dennis Dick. Let's take a look at what he was looking at, especially on Friday. How was your Friday action?
Friday was good. Just some housekeeping here. If your feed is choppy, hit refresh. It seems to be working now. I don't know why, but for me, the feed was coming in and out. Then I hit refresh, and then it was working better. So if your audio or your video is coming in and out, hit refresh. It should be working. If not, let us know. A couple little hiccups there. It's been a while since we had technical hiccups here. Friday was good. Interesting enough, we talked about the SPY potentially bouncing at the January 25th low of 393.56. These Joel Elconin levels just work here because it's exactly where we bounced. 393.64, the low on Friday, bounced out of there. I mean, we're kind of still, I believe, going to be in some chop. I don't think we're clearly down. I don't think we're clearly up. I think we're just going to be sideways for the foreseeable future here. I think you got good support down at 388 to 390. So if you were to drop another 100 points, I think you got great support down there. And then as you get up, you know, to the 405, 408 area, you're going to have a lot of people who maybe were getting caught thinking about a breakout trying to get their money back here. So I think you just chop around here, again, coming out of earnings season. It's going to take another major catalyst, and we don't know what that major catalyst is going to be. Maybe it's going to be geopolitical, and we can get into the China talk now if you want, Mitch. But I just don't see a clear road or path for the bulls, and I just don't see a clear path for the bears ahead. And that's why I think I just continue to predict more chop.
Yeah, it's going to be very difficult. Let's talk a little bit about the tensions that are growing. Of course, I know if you guys probably watched this weekend, there was U.S. military aircraft flying through the Taiwan Strait. China today publicly complained about that aircraft. Of course, it was a fighter jet, and it was told by a China fighter jet that it needed to go ahead and get out of that airspace. If not, they would intercept. The United States also warned China of serious consequences if it provided arms to support Russia's invasion of Ukraine, heightening tensions, of course, with the two economies. This was reported also by CNN that if it goes down that road, it will come to a real cost to China. White House National Security Advisor Jake Sullivan told CNN. So, of course, heightened tensions in China, the U.S. with Russia. Of course, China did mention last week that they were telling Russia that they were looking for some peace. Well, it looks like they're actually going to be having a meeting. The president, of course, Putin, going to be having a meeting with China. It looks as early March. So keep that in mind when we're thinking about the tensions outside.
I mean, there's so many, and you were saying in the pre-market show when we were just talking before we started the show, Mitch, like the market is walking on very thin ice here.
100%.
And eventually, I just think it falls in. So there's just so many things to worry about here, whether it's, interest rates continuing to go up or inflation, disinflation starting to go back to inflation. And then you get the whole geopolitical situation. You're like, it's again why I remain with a lot of cash right now. Because again, when we were investing 3 years ago, you had sat in cash, you're getting nothing. You're getting less than 1% on your money. Now you sit there and you get 5. So I'm like, well, I don't mind sitting in cash getting 5, because if I'm wrong, I'm still picking up 5. But if I'm right and this market starts to sell off, I'm going to pick up these stocks a hell of a lot lower. So the stocks really, over the course of next year have to go up 5 for the market to break even with your cash call. I just don't feel like we're in this rah bull back to new all-time highs markets. I mean, just the math doesn't add up. So that's why I continue to invest very cautiously. Trading perspective, sideways, just fading everything. And bring it into UNP here this morning, because this is one of the dumbest moves I've seen in a long time. Again, it's hard to fade on day one, but give us the news here on UNP. The stock is up 20 points here this morning. This seems way ridiculously a gift to longs.
Union Pacific shares are trading higher after the company said it would name a new CEO in 2023 after hedge fund Soban Capital Partners called for leadership changes. So it looks like they're really happy also that this capital fund is kind of leading the party here. So they're getting definitely the lift there. And you also saw some analysts start chasing. I started seeing different upgrades. There's a BOA upgrade right now to buy, raising the price target to 241. So keep in mind, you could start getting some analysts to chase this price action.
Well, they're chasing it right now here today, and it has continued to go higher. And it is hard to just stop the rocket ship and call it. But, if you're looking for an out, like sometimes it's not that easy to short the things, but sometimes it's very easy to just take the profits. If I was long the thing, I'd take the profits at 214 right now. Just my opinion. I think you got room to 220. There's a lot of resistance up at 220. So you could have another $6, but risking, quite a bit to pick up the last 6. I'm not sure I want to do that. So if it was me, I'd sell my long if I was long it at 214. Shorting is tougher. I usually like to wait until you start to actually see some sellers come in. We have not seen any sellers come in here this morning. And this is the one thing about shorting stocks. I short stocks every day. You never want to be early shorting stocks. It's okay to sell your longs and be a little bit early, but when you're shorting stocks and you're early, you get punished severely. I usually like to wait for a red candle, or I like to wait until I at least see, some of the relentless buying subside. And right now, this morning, UNP is just had a relentless buyer all morning, just going up on this. But is this move overdone? I believe so. So I'd put it on my watch list for shorting, and if I was long, I'd say see you later.
Yeah, I think definitely the intraday momentum is a little bit too over exuberant. But one thing, of course, is the long-term chart on like a UNP, right? Long-term chart, railroads keep going up. It just seems
and
like
the PE
it, right?
is not. Where's the PE? And again, this is a value stock. Last time
Definitely.
I looked, we've had a lot of issues with, obviously, the derailment.
17.
Lately.
17.
Yeah, so it's not crazy. I mean, it's under a market multiple, and that's where they typically trade. Let's look at like a CSX just for comparison here on the multiple. So CSX, not showing me.
I got 16.
16. So you're right in there. I mean, that's where they trade. They're value stocks. It's kind of stock I kind of like better than these growthy tech stocks, but at the same time, it's just too much too fast. 21 points on this news seems way overdone.
And of course, maybe, you know, there's a lot of talk right now of what happened in Ohio. Could this come into effect a company like this? I think that's something to keep in mind, right? You never
Something to
know.
think about.
It's something that could change up this action. Yeah, it's getting a new CEO, but what if there's some regulation controls that affect their costs and stuff like that? I'd keep
What if
that
there's
in
more
mind.
derailments?
Yeah, or more derailments, exactly.
I mean, there's
So
been
keep that
a
in
few of
mind.
these now. It's scary, and we don't know why. You know, some people are saying it's terrorist attacks. We've heard a lot of different reasons. I don't know if we've ever really heard, you know, the reasons as to why, you know, we've had multiple derailments here, because it's not something that's common. But anyway, there's lots of things to be concerned about with the rails. And you get this 10% pop on this news. Holy macro, these news algos, they just get so excited. They're so excited. I think you got to fade them a lot of times.
220 does make sense, and especially monthly wise. Daily wise, you can also see that clear resistance up there, as Dennis pointed. All right, let's get out of UNP. We can also just talk clearly about the implied federal fund target rate. Now it's starting to show a little bit higher as we keep kind of creeping towards the next interest rates rise. And do you think that, you know, 50 basis points could be something that the Fed does here to try to show that they truly have a handle and really want inflation to come down? Do you think that could happen, Dennis?
Well, I think Blue said it best. I believe it was Blue saying it best last week. He's like, they've started at 25, so it's probably where they're going to continue to go. But he saw 3 more 25s. So still getting there, just getting there a little bit slower. 25, 25, 25. So I think that's where they're heading to. Again, it all depends on what that inflation data coming in is going to have. So if we start ticking down, they can get less aggressive. But, you know, inflation, you know, even the PC, it's not crazy. We haven't really started blasting off here again. So I don't think there's the concern that, oh my goodness, we got to start raising rates faster. I think it's just not going down as much as quickly as they'd like, and obviously, you know, ticking higher last month.
I have a graph for us. So
yeah,
look at the
show
graph
me that.
here.
That's nice.
Here's a graphical representation. This came from Reuters, so shout out to them. They have some good graphs. I've been kind of taking them, but hey, I'll give them the shout out here. You can see it here, how we were going up there, and then we started peaking right before July, right? And then this is PCE, right? We're talking PCE. Then you can see that down dip in October, down dip into December, and then a little bit of a push back there in January. I think that's really where, you know, it could be just a blimp in the statistics, right? We could just get a little bit of a bounce. We did see oil prices jump there. But one thing that I've also noticed is that we're not going down as fast either, right? And if we're going to slow that pace down, that leaves room, at least I feel, for higher interest rates in the future, right? They can continue raising because our jobs are not going down. The economy is not cracking. What makes them have to stop? Nothing.
Well, they don't have to stop.
They don't.
And that's the one thing, like everybody wanting a pivot. They think, well, as soon as you get inflation higher, they're going to start lowering rates as fast as they can. That's not the recipe. The recipe would be is if we start to go into a recession, they're going to start lowering rates. But this market isn't pricing in a recession. So that's why I keep thinking for you to get, you know, the market to get the pivot that it so much wants, we're going to have some pain ahead of that. So maybe it's the opportunity, you know, on the short side, or maybe it's the opportunity just to not have stocks where if we do go into recession, then you'll get that pivot. And I think that happens. I think we are going to go into recession. I think we do eventually get a pivot, but there's going to be a lot of pain to get to that pivot. Once they start talking pivot, to your point, you've said this too, Mitch. I mean, you don't want to be early on this. You definitely don't want to be early on this, because if you're early on this and all of a sudden you don't get that pivot, or all of a sudden, you know, it starts to just get ugly in the markets and they're still not talking pivot, this, you know, there's a lot of risk. It's just risk reward, and the market's not cheap. So
there's also the scare, right? Powell started talking about disinflation, and now we get a little spike in the data where it shows inflation rising a little bit. Will he be talking about disinflation this time around? I don't think so. If anything, I think he's going to have a little bit more of a harder stance. I think he saw how the market reacted to that comment about disinflation, and now he's probably thinking, well, I got to take that word out of my vocabulary, because if I keep mentioning that, the market could get ahead of itself. Feel like that's what happened here. Market got a little bit ahead of itself.
He totally caused that. He totally caused that spike up in the S&P. the disinflation, and they ran with it. We talked about him saying it, 9 times one day, and then came on and again saying it again. I think he regrets saying it. I think he caught a lot of people on the bull side. There was so many people who were getting bullish 2 weeks ago. And a lot of that was caused by Jerome Powell talking about disinflation, like we have it beat. And then it starts ticking higher immediately. I think it was Cameron that says Jerome top-ticked it with that word. Top-ticked it. CPI started to blast off, or not blast off, but started to turn. So we've stopped going down. That's the whole problem here, is that we've seen, CPI coming in, and now it's slowed down the disinflation process here. And that's concerning. If it starts to tick back higher, you will see some of these Fed officials start to get more aggressive. And we are kind of starting to see in the PC data, starting to tick back just a little bit higher. And you feel it in the stores. We talk about that. Go into the grocery store, you feel it. You can feel, people want raises. My brother-in-law, electrician, he's got an electrical company trying to hire people. Everybody wants a lot more money than what he figures. He's throwing it out there trying to get, at a certain rate. And he got 3 responses, asking for, I think it was $36 an hour asking for. Exactly. 3 responses, and everybody says too low. I mean, people don't want to work, at all, really. And they're not going to work unless you're paying them. So this is the market that we're in. But as you raise labor prices, the vicious cycle continues. As you raise labor prices, then the companies who are obviously paying their employees more have to raise their prices of their products to make up for it. And then the price of the products go higher, and the laborer says, well, I need more money because it's costing me more at the store. So then it goes like this and goes like this. And this is how in other smaller countries you have hyperinflation. Now, we're a long ways away from that. Don't worry about that over here. But that is the process of how it gets started, and they don't want to lose it. They don't want to be all of a sudden, where we're looking at inflation rates ticking back at 7, 8, 9, 10%. Then we got problems. So this is why the Fed has to stay the course. They're doing the right thing. But eventually, there's got to be some short-term pain for this, and we have not had any of the short-term pain. Yes, growth stocks, some of them went down 60, 70, 80%. They all deserve. They were all going to go down that no matter what, even in a lower inflationary environment, because they're just, the multiples were just not sustainable. But I think you're going to start to have some pain in, some of the other stocks as well. The value stocks, a lot of them are near all-time highs. I mean, the DIA, look at look where the diamonds got to. I mean, we were like 4 or 5% from an all-time high. What business is, talking about, record sales at all-time highs? We should be seeing record sales and record profits. And yeah, there's a few businesses doing it. The majority of businesses are not doing that. I mean, and the tech stocks, the mega cap techs, are talking about a slowdown. So
yeah, and what did Meta give us last week, right? Meta gave us something that I think is important. What did they say? Oh, we're going to look at our second round of job cuts. When will the market start reacting negatively to these job cuts, right? If we start seeing a second round from all the big boys cutting jobs, eventually I think that this has to start turning around and probably be viewed as a negative for future earnings. But something to keep in mind, right? Let's go to Berkshire.
And that $36 they're saying, $50 for an electrician. These actually were apprentices. They weren't talking licenses, not licensed electricians. Just starting out, like getting started. That's how. But again, we're in Canada too, so you need to consider that. But yeah, like $30 to start. No license, like coming out of school.
Yeah.
Tough.
Wage inflation is real, and I think that's one thing.
$18.
We've talked about this plenty of times.
$18 to start at McDonald's.
If you're going to make 18 at McDonald's, I'm telling you, it can only be so long that the worker out there starts thinking, well, then I need my raise, right? They got a $5 raise. I want my $5 raise, right? Well, we'll see what happens there. Let's go to Berkshire now. Berk A. Let's take a look there. Hey, Dennis, would you ever in your right mind go for a share of this?
Not Berk A. I don't even like bringing it on my screen, and
it scares me a little bit.
I accidentally click it because I have a buy button on the screen. I don't even like bringing Berk A on my screen. Berk B, I trade all the time. Berk A, I don't even like bringing it on my screen. It's got too many numbers there. I don't want to accidentally click it and buy something $100,000 too high. So I don't even like bringing it on my trading screen.
How's the offer on that? Do they go wide on that?
Yeah, maybe.
I'm sure they go really wide. All right, let's talk a little bit about what happened here. First, let's talk a little bit about, let's do the shareholder letter, because I thought there was some interesting comments there. It was focusing on repurchases. I don't know how you guys feel about repurchases. I've been talking about them. I've been a little confused of them, but Warren coming in here and telling me what I really need to focus on, right? He said, if you're listening to about repurchases, and if you think they're harmful to shareholders or the country, or particularly beneficial to CEOs, you're listening to either an economic illiterate, so he's talking about me out there, or a silver-tongued demagogue, said by Warren Buffett. And Buffett believes buybacks are beneficial to shareholders as they provide a lift per share intrinsic value. And so that's where he definitely thinks they're important. He also highlighted Apple's shareholders buyback, of course, Tim Cook's repurchase program. He thinks that is really well done. He thinks that he thinks that the increased ownership of each dollar of the iPhone's maker's earnings without the investor having to lift a finger. So essentially, it strengthens the company without the investor having to put money into the company. So that's why he feels that repurchasing is great, because at the end of the day, it's like the company reinvesting in itself.
He's always been a big fan of buybacks. He's believing in himself. You're exactly right. And buybacks can work well as long as the companies are smart about it. You know, it's the ones like IBM rebuying their stock at 220 and now it's 138 and you're like, so when the business is going well, buybacks do really well. But a lot of times what you see is companies like starting to slow down and they're like, well, you know, we're having a bad quarter. Well, let's do a little bit of a buyback with it just to try to help the quarter out. That's not the idea. That's not good for shareholders. Your business is starting to slow down and struggling, and now you're doing buybacks to just try to keep your share price up. I don't think that's the way. But this, you know, a main reason that Apple is where it is and the valuation is where it is all the buybacks over the years. You know, and obviously, you know, earnings overall have not maybe increased as much, but EPS has, because they bought back so much stock. So buybacks do work on good companies, and it's worked for Apple for a very long time. It doesn't work that well when the companies are struggling. So I don't like it when you see a bad quarter and then they announce a buyback trying to, you know, stem the tide, if you will. And I just think buybacks are more for companies when it's going, maybe, you know, you get a dip in your stock that's unwarranted, but when you're getting hit on your earnings and you put a buyback in there, not for me.
Well, let's talk about their earnings. Q4 operated earnings of $6.71 billion, down 7.9% year ago. Operating earnings reflected total profits of the business for Berkshire owns and operates. They disclosed a record operating earnings of $30.793 billion, up 12.2% from 2021. Of course, they also called it a good year for Berkshire despite currency, inflation, and supply chain headwinds. Net earnings, though, fell 54% year over year to $18.164 billion in Q4, 75% to $22.81 billion for the full year. So definitely net earnings coming down a little bit here. But of course, that reflects a lot of what Berkshire holding there with their Dow stocks and heavy equipment investment portfolio.
The biggest reason I don't invest in Berkshire Hathaway directly is mostly that I just don't like paying the premium. There's a Warren premium in there. You're buying the stock significantly above NAV. What happens if he does actually? I know this is a succession plan here, but he's not a spring chicken. And if he was to get sick, you know, or, you know, even potentially, you know, he's getting older. So at a certain point in time, he is going to die. There has to be a succession plan here. Does that premium just get sucked out of it immediately? I don't know. Again, fabulously run company. I love Warren Buffett. I wish Warren Buffett was 50 years old. I wish he was 50 years old, but he's not. So that keeps me away. I don't like paying that huge Warren premium when, you know, he's as old as he is. But with that being said, Warren is somebody that I've idolized my whole entire trading career, at least from an investment standpoint. I've tried to mimic what he does with my own investment holdings, looking at good companies at reasonable valuations. Everything Warren has done has, you know, so many lessons to be learned. As one of the first books I read was The Warren Buffett Way. I mean, from an investing standpoint, he's just knocked it out of the park.
Yeah, and we can think about like what are his top holdings, right? You got about 38% in Apple. You got about 11% in Bank of America. I don't know about that one too much, but you got Chevron in here. You got Coke,
It's all
right?
value stocks.
All value
Except
stocks, right?
Coke, which has just
Yeah.
grown. It was a value stock at one time. It's just grown so much in this hiding in consumer staples. Has expanded the multiple. Apple obviously is the biggest one, and I don't know why. I guess he just doesn't sell. And Apple, when he started buying it, had a P of like 12. It's just expanded. And I've sold my Apple for the simple reason that I feel like it's overdone. It's another reason I just don't feel like he's as diversified as he once was because he owns so much
Yeah.
Apple. But again, how do you
I'll tell
argue
you what helps him. Oh, you know what helps him?
What?
I don't know if this is 100% accurate, but this is from hedgefollow.com. It says that the average price on that Apple is around $36.98. If I had $36.98, I don't know about you, Dennis. I'm not selling.
I don't want to pay the tax. Well, I did too. My average cost basis on I did too. My average cost basis on my Apple was $25, so similar.
There you go.
Average cost basis was $25, and I sold mine. I sold some at 170, and I sold the rest at 155 and 150. I had calls written, and I got called away. And I am going to pay the tax bill on this, which sucks. I broke it up. I did half of it last year and half of it at the beginning of this year, just to try to break up the tax bill. It sucks. I just got to a point here though where I'm like, I just can't stomach owning this thing at 24, 25 times earnings. I know they might continue to grow into it. I know they're going to continue to buy back stock. I know they got the cash cow of the iPhone and it's probably not going away. But it just seems like if that came down and got back down below a market multiple, I would be kicking myself. So it's the reason, that I've sold the stock. And at 170, it was trading like 26 times earnings, just a little bit too much. So I did pay the tax bill. I didn't follow Warren's approach on that one. Part of me thinks, it's going to suck come tax time, which is coming up soon in Ontario, to cough up, that money for this. Obviously, on half of it, I don't have to pay till next year because I sold some of it in January. But, you know what? If you're making money, eventually you do got to pay the tax.
How do you feel about Apple now as we've gotten this decline? Is this one that you'd be looking for a dip to buy? Or
no? I've said before, I think Apple could eventually go under $100. I think unless they come out with some product that we all have to have, it's a cash cow now with a multiple that isn't warranted, in my opinion. And I think we're going into a recession. And I would not be selling. If I thought Apple was only going to go at $10, I wouldn't have sold it all. But I had the opinion that Apple could eventually go under $100. I'm sticking with that opinion. I don't want to own Apple at these prices.
We'll see what happens there. Can it get back towards the 150? I think it's so vital if it can get back there this week. If not, I do see that decline coming in really quickly.
I think you're selling rallies in Apple. But
we'll see what happens there.
I've sold my stock a little bit higher, but not that much higher here. So, and again, if we don't go into a recession and we just go into this rah bull market, new all-time highs, I'll regret those sales. I don't think that's going to happen, but I don't have a crystal ball either.
All right, let's go to the next major headline that was out there. This is going to be more into the health area, and we're talking about Pfizer, and Pfizer's in talks, and this is getting reported from the Wall Street Journal. So let's go to Pfizer and Seagen here, as it looks like Pfizer's in talk to acquire the biotech firm Seagen. The deal is expected to command a premium above Seagen's market cap of roughly $30 billion. That people told the Wall Street Journal. Seagen, of course, you guys can look it up, SGEN. You guys can see that definitely getting a nice little rip up past the resistance of the 180. So that's around where I'll be looking for some pullback on this. If you're looking for opportunity, I think it's below 180s. You can see we already kind of pulled towards 179.50s. And look to see if that 180 holds. But what do you think about this deal, Dennis?
I don't think much of it because I'm a Pfizer shareholder and my Pfizer stock is down on it. So I don't like paying the premium here. I mean, Seagen has been rumored to be taken over for the last couple of years, really, by different companies here. So now it looks like it's going to be Pfizer. Sucks that it's one of my companies that I own because they knock them down when they're paying the premiums like that. Pfizer's just a mess. I very much screwed up when I underestimated how much revenue is coming from COVID. We've seen what's happened with Moderna; it just goes down every single day. And BNTX, which I don't like at all. I would be a seller of BNTX, and Novavax for that matter too. Although Novavax has been killed so much, there's not much left meat on the bone there for the bears. But I mean, Pfizer is diversified, lots of other things, but there's a lot of revenue that came from that obviously the COVID shot. I don't think people are getting the jab as much. So I screwed up by buying more. My average cost basis on Pfizer was $13 before I bought more, and obviously it's come up substantially. Wish I wouldn't have bought more. That was a mistake. I'm still long it though.
Yeah, I got caught last week in Lilly. Was trying to catch that dip right down here, thinking that we were going to come back into the gap zone on Eli Lilly. I got caught on that move, so can't blame you for looking at stocks like Pfizer. Even I was looking at it last week. I was seeing it make kind of these kind of double bottoms around here, around this kind of 42.50, thinking it was going to come back, and this just continues on the leak right now. We'll see when these healthcare stocks come back. I did see some of them start making their way back. Like you could see Merck starting to climb back here, right?
Yeah.
And so I'm keeping an eye on some of these, like Bristol Myers.
I like Bristol Myers
keeping
here.
an eye out.
I think Bristol Myers is a sneaky buy here. I don't mind that one too. I mean, Lilly's got that weight loss drug. So I think on a buy, I think I'm agreeing with Kramer here. I don't always agree with Kramer. In this case, I do think Lilly is going to be a buy here eventually. It's come off substantially too. So I kind of like that one as well because that weight loss drug is going to be a big one. But the problem with Pfizer is the COVID jab, and Moderna is obviously showing you direct. So when you just have the COVID jab, and Moderna's trying to do some other things too. But I mean, holy, this has just been murdered. At a certain point in time, it's going to be a buy. But I just, again, this is why I said I couldn't buy Moderna at 160 was, and I did say I like the pair trade 160 Moderna long versus BNTX short, which I would be down slightly in that, I think, right now, because BNTX has come down about 7% or so, but Moderna's come down more, I think. I still like that pair, which would be a Moderna long and a BNTX short. But I don't want to be straight up long Moderna or but not BNTX at all. But I think Moderna's run very well, but I just can't quantify how much those earnings are going to drop from people not getting the COVID shot. So that's why I'm just staying away from that one. Now, again, Pfizer is very diversified. So a lot of other revenue coming from a lot of different sources, which is why I like that better. But they're hitting Pfizer, don't kid yourself, because they're hitting Moderna, and some of that revenue is going to go away.
Mm-hmm. And I think that, you just got to find what works best there. I know Merck has been coming back there. AbbVie hasn't been that bad since their earnings. You could see this was their earnings pop. That's been going sideways there. We'll look to see if that climbs back through kind of the 155s. And just to mention ETF, right? IBB has been on the pullback here. A lot of people were looking for this to kind of break out above the 140s. It's pulled back recently. Let's look to see if they finally start buying the dip there. Another stock that I'd keep on watch is VRTX. That's been pulling back. That one was so strong. Now starting to break down. Will this reverse?
That's interesting. They're and I believe they're the what's that disease? Oh man, now I'm forgetting what the disease is called. I'm getting old when you just start forgetting stuff. They got the drug. Help me out, chat. I'm missing it. I shouldn't have
I'm so bad with biotechs, but I know
but they got the big drug
important.
for the rare disease hits the kids. Now I gotta go look.
The chat will get us
next. It's not Alzheimer's. Vertex is C. Anyways, all
right. Well, the big thing is big decline. I like this kind of weekly pullback to the 50 area. It's off of this kind of high here from the April 14th levels. Look for maybe VRTX starting to get a little bit of a bounce back. I like some bottoming action below this around the 283s. That's where we got bought up like kind of last time, somewhere between 288, 283s. We'll look to see if this can come back towards 300. All right, getting
cystic fibrosis was what I was thinking of. The cystic fibrosis drug that came out a few years ago. It's cystic. It's Greg. Thank you. It was cystic fibrosis.
Greg got it.
They have that drug because it's not a lot of, and the drug that they're doing is really doing wonders for people with cystic fibrosis. So that's what I was thinking. But again, we've had a big run, and that's what you have to consider on a stock like VRTX. It's $185 a year and a half ago. Now it's $285. So.
Yeah.
Again, I think the drug stocks hold up better during a recession, but if we go into a hard recession, everything, maybe gets hit.
Everything.
So durable goods we had here, Mitch.
Let's go to
our guest. We got durables, and that's down slightly. It looks like January, and that's giving the market here a lift because obviously we don't want. We want the Fed to have reasons to slowly raise interest rates, so we're getting a little bit of a lift here off that. Again, as we get up over S&P 4, SPY 400, get back to S&P 4000, I think you find resistance.
Definitely a surprise there. And when we look at U.S. durable goods, excluding defense for January at a negative 5.1 versus a 5.6 positive prior, right? Definitely a change there. When we look at the core durable goods, This is at 0.7 versus a 0.1 estimate there for core durable goods. Durable good orders for month over month, January at negative 4.5 versus a negative 0.4 expected. Prior was 5.6. So getting the lift back there, it looks like we're working our way back towards the 400 on the SPY. We'll look to see if we can get there during our interview. Let's go ahead. Let's get out of the SPY. We can talk a little bit about that with our guests coming up. You guys know what time it is. A little shimmy time to get it going here. It's Tim Quast, Market Structure Mondays. All right, Tim, how we doing today? Welcome back.
Good to see you, Mitch. Thank you. Happy Monday to you both.
Definitely.
Where's Joel? Where's Joel?
Joel took the day.
Alarm clock problems?
Yeah, no, he actually had a
weekend,
family. He had a family member an aunt that passed away. So
I'm sorry to hear that.
Yeah.
Yeah, so he'll be out today. No worries. He'll be back with us tomorrow, like always.
Okay.
But we'll have him back. Let's get to the market action. Of course, one thing that you were telling us, I think even a week or so ago, that we were finally starting to see a little bit of a turn. Now, I think one of the things that we need to really be thinking about is which direction do we go from here, right? Tell us,
Right.
What does Market Structure Ed say, at least?
I'm giving some props because you were being cautious going into the last week or two here. And Tim, caution was the key here because we come off substantially last week. It was not a good week for the markets. Is there a reason to, get a little bit more bullish here yet, or still exercising some caution?
Well, I think that traders should think about the sort of the cadence and calendar of the market. I talk about context all the time. There are three big things that matter to me. What is broad sentiment doing? So what can we see the supply demand balance in the big money that flows through the market and really determines what direction it goes? Then are there things occurring like earnings and options expirations and so on? And then you look for divergences. And the combination of those three things will tell you a lot about what the market's likely to do. So that's a market structure view, but that's how I think about it. And to me, the data it's startling what the data show. And I'll show you what I mean here.
Let's look at the nitty gritty. This
is what I do. I will look at this every day. And the first thing I'll look at is where is broad sentiment? And if you think about it, there are all kinds of ways to measure the market, but this is a simple way. I'm a simple guy. It's a 10-point scale. So to have demand that will cause prices to generally rise, this number needs to be above 5.0. Well, it's not. So you know that the market is going to have a bias to weakness if that number is below 5.0. And like I said, it's just a measure, but it's an algorithm that meters buying and selling under the market rules to see which direction things are going. It doesn't matter whether prices close up or down. It's really how they close relative to midpoint, because the rules of the market force prices toward midpoint. And so as the number of days that things close above midpoint declines, tells you there's a bias towards selling. So that's one side of weakness. And then I come down and look at the supply side. Demand side, falling. Supply side, well, on Friday, the short volume in the S&P 500 reached nearly 51%. So the market is more short than long. So it's much more difficult for prices to rise. Context, index futures used by trillions of dollars to hedge exposure to the market expire tomorrow. So either side of that can be volatile. You can have a strong update. I bought things on Friday because I believed that the market would be up today, no matter what the economic data, but because there will be an effort to move prices toward a midpoint when index futures expire tomorrow. So then one side or the other, the market will be up. It's a gamble. I thought, well, based on the market activity on Friday, so I bought a market hedge on Thursday, a short S&P 500 hedge. When the Dow was down 470 points, I sold it. That was my only gainer. And I bought KMB and I bought Crocs, one out of low volatility and one out of momentum. But here's the thing, folks. So when we're with Edge, we measure whether there's an upside opportunity or an opportunity to make money when big dollars cluster in things that don't move much. That's low volatility. Well, look at the number of components. That's very, very telling. There are 5 in low volatility. It just means that across the whole market, there are very few securities that offer the kind of sort of safe harbor that big money would look for. And then look at momentum. There are 2. That is it out of the entire market.
What are the 2? I think that's the same one from last. Wasn't Coke one of them?
No, that would be a low volatility.
Oh, that's a low volatility.
So there they are. They're
Ooh, the DraftKings.
And DraftKings. Yeah,
and its momentum starting to slow.
Swung that short, baby.
They're not great, but see, the reason that we point these out is there is this kind of opportunity to make a gain. We look at volatility. How much do prices move intraday over an average period of time, a week? And so you'd say, well, if DraftKings is down Friday 3 or 4%, there is a good chance today that you can make 3 or 4% because that's taking half of the volatility. So those are things that you can use. I bought Crocs for the same reason. It's already out of that portfolio. If I'm looking at Crocs here, and here's how I know, and I want to show you one more thing because I think it's telling. So I bought Crocs because demand was rising and supply was falling. They're already breaking down. So I will leave that today. You just have to take what the market gives, folks. It doesn't matter how much something goes up if it goes back down before you sell it, right? So you have to be aware of those things.
Tim, what do you do? And we never talk about this much, but how do you manage your losers? Because obviously as traders, we all have losers all the time. And in some cases, I'm sure you can see, lower supply and rising demand and the stock price actually goes down. It doesn't work on 100% of the time. How do you manage your losers?
By being very careful about broad sentiment, context, and divergence. I try to minimize them. We're all going to have them. I had one a week ago where I lost about $1,000. That's about as much as I care to lose. But how I do that is if the supply demand equation has changed and I'm down in a stock and it recovers some portion of it, I leave. You have to cut your losses. I don't tend to use stops and limits because you miss what the supply demand equation is going to give you. It's meant to be predictive, and prices are very volatile. Supply and demand are not volatile. Prices are. So you can miss out on things by using stuff. And I'm not saying you shouldn't. You should do what works for your risk tolerance. What I try to do is be concentrated in things where I've got the mass stacked in my favor. But one other thing I want to show you here. So here's how I think about this. Here's the long side of the market. The long side, there's almost nothing. This is telling us the long side of the market isn't good. So if I go down to my short beta portfolio over here, and it's the exact opposite. Notice that demand is falling, supply is rising, converging supply and demand, the exact opposite of what you do long. Long, you want rising demand, falling supply. Look at the number in this. So there's 2 in momentum, which is rising demand, falling supply, and 93 in short. Well, there you go. The market is at present, no matter what it does today, and until further notice, a short trade, not a long trade. And I'm not great at that. I use little bit, I aim small, miss small. I don't know a lot about shorting. I use SH principally for that because it's very liquid. But that's what the data tell us at present.
Love it. Love it. So definitely we're going to be looking for some possibilities in there. What about the recent strength that we've seen? Of course, in the beginning of the year, we saw the NASDAQ and tech stocks really bounce back. Now it's starting to come right back down. Is this kind of an opportunity, or should it be something that we should be running from?
Well, here's a great example right on the screen. If you look at semiconductors, I've got 15 in my semis portfolio. I enter the tickers. Look at the supply demand equation. That's what you look at. Which way is demand going? Down. Which way is supply going? Up. Until those things change, or at least bottom out, semiconductors are not a great place to be. So now let's go look at the tech sector. Here's the tech sector. So Our sample, which is most of that GICS group as identified by the S&P 500, S&P Global, we license that data. Here's demand. Dead flat, even ticking down a little bit on Friday. Where's supply? Rising. It's below 50%. It's not terrible, but that is not what I would buy. Those are not that is not the place to be. So
what's the number one stock in information technology there?
That's a great thing to do. So here's let's go look. Let's see what stuff in tech it has strength. And that is exactly what you want to do. So we come in here and I want to sort by demand. Let's go. What's at the top of the list, and maybe then even by dollars per trade. But here are the 10s, and I go look for the most liquid thing that's a 10, and it's the same stock that is in the momentum portfolio. It's already found that for us. So Procore Technologies is a mid cap, because we look for things that are liquid, because things that are illiquid, like SNC Syncor, it trades $350 at a time. You can't get in and out of that stock. It's very dangerous, but you can get in and out of PCOR because it trades $5,500 at a time. But that's about as small as I'll go for those trades. Look, there's not much. And that's kind of how I look at it. $8,300 is Cisco. Cisco's actually a pretty good stock here. And that's what you look for.
Value.
Look for supply, demand.
Value stock.
Yeah,
you can kind of see what they're starting, and we've pulled back here. Cisco is interesting. I had the earnings pop, and again, we have to realize in this market that we're in, buying those rips is just not working. Cisco held up for 2 days after the earnings pop, and look, here it is 5 days later, gives it all back. So now you're coming back to that point of 48. I actually don't mind down here either, just for the potential bounce aspect of it.
Right, and you're not looking for much, folks. In Cisco, your return opportunity is very small. It's like 2%. But realize, what we tend to do as traders is we think, I want the thing that gives me 100% return. Well, there aren't very many of those. There's a lot more opportunity to make 2%. And if you make 2% a week, you're up 100% in a year.
Yeah, that's a great point. It's how I try to do my trading too here, Tim. It's like I just base hit it. And I'm not even going for 2%ers. I'm going for less than that, because I do a lot of index arbitrage and different stuff too. But I do make calls on stocks as well. And I'm never going in looking, I want to double my money on this stock. I mean, we're not in this, and maybe in 2020 it got to that point, Tim, where you had these, penny stocks or dollar stocks or $5 stocks were going to 10 overnight. AMC going from 5 to 20 overnight. We're just not in that market environment here anymore. Definitely. So if you're looking to double your money in something, you're holding on, and what happens is you get up 10%, and then you're like, oh, you're back down, and you're like, well, why? All of a sudden, I was supposed to go up more, and I gave it all back. What did I do wrong? Well, the environment you're in, and the environment is take the money and run.
Exactly.
That is expectations, right? Yep. Expectations in the market need to match the belief, right? And I think a lot of that is Tim giving some good lessons there, in that if your expectations to make, 40%, 60% every trade, well, let's just be honest, that isn't probably going to happen, right?
Right. If you've got this kind of demand, so if you go back to the end of the year and demand dropped below 4, so that's a green line. Now we've got a green light saying there's a real strong chance of a bottom here, and this is rising, and then supply has peaked and begins to fall. The probability that you can trade momentum is very high. And you'll have up and down days, but that's going to give you a lift, and so then you can chase momentum. And we don't have once demand peaks and begins to fall right at options expirations, and supply begins to rise, momentum is over. And then you have to shorten your time frames, shrink your expectation of returns. And that's what you do. And you can do fine in any condition, but you have to be patient. When the data aren't there and they're not giving you opportunities, then don't try to chase them. You'll end up just hurting yourself.
Tim, can we jump into just a couple of the earnings stocks and look at, what you're seeing for maybe a potential like Zoom tonight? It's one that they're talking about. So we have, 3 major reports tonight: OXY, which I have a position on, WDAY, and Zoom.
Okay.
So let's go to Zoom first. It's a stock that a lot of retail traders like to trade. It's widely known. Let's see what Zoom says.
It's not great. If I were, I would take. This is what I would do.
The report
I would leave it today. If it's up, if it's up 2-3% today, I would leave it. Here's why. Okay, so see, demand has stopped rising, and it's not even back to 5. It's not enough to even hold the bid in the offer. and then supply is rising. Supply is at 65% of the trading volume is short. This is here's a long bet. There is a long bet, but it's not very good. So I would look at this and say all the hedge funds are betting short. Now they could be wrong. That I could make a case for why Zoom could beat expectations even if its results aren't great. But this is where you make a decision. I look at the math and say I'm comfortable being wrong if it's up, like Nvidia. Nvidia I would not have owned, and we'll look at Workday and Occidental here in just a second. But if you look at Nvidia, so if I looked at Nvidia before results, would I have bought it? Well, no, because demand was falling. There were some pretty long bets in Nvidia, but supply was rising, demand was falling. I wouldn't have done it. We edge users did. There were some who had it, but I say they got to take those gains because the supply demand equation isn't good, and Nvidia is going to decline. That's what this math tell us. So you should know that. If it's up today, look, take your gains. You can always come back and buy it. When demand is screaming at the ceiling and supply falls, you're going to make money. But when those conditions break down, look out. Okay, so Workday and then
Occidental Petroleum, the Warren stock.
One of the great stocks of 2022, the best in the S&P 500. That's better. So Workday actually, so you look at the supply demand equation, below 50% short, demand steady. This stock has a much higher probability of producing sustainable gains, meaning a number of days of gains, than does Zoom. So if you're going to take one, there's the one to take. Then let's look at Occidental. And energy I'm surprised by it. I didn't expect it. It has rolled over and it's turned weaker demand, higher supply. But let's look at, a couple stocks in that group did very well. Again, I would say the supply side is fine in Occidental, but the demand side is very weak.
We need Warren. Warren, get in there.
Warren.
Right. That's right.
Warren, come save the day.
I know. Come save me on my Occidental Petroleum. Come save me.
What about Target? Target's been sleepy for so long.
We've got a bunch of retailers reporting.
Yeah, they report tomorrow morning. So I've been looking for that huge gap if we're ever going to go and fill that on Target, because we've seen some of these huge gaps. Like there was in Netflix, right? For a while, everyone was like, "Oh, never get back there." Oh, it did.
Well, so it's not great, Mitch. Here's the demand is falling, and while there's a big drop below the trend, this was a huge short here, and it paid. Stock came down from 180 to where is it now? 167. And so people have covered their short positions. The trouble is it's still well over 50%. It's 56% short, and demand's at 4.2. I would not own that into results. It doesn't mean, does this set up a recovery? Yes, but I love stocks that are 5 and higher with supply below 50%, because then you have a long bias. Those are much more likely and much more statistically true to deliver gains than this. It doesn't mean it won't, because earnings can change outcomes, but I wouldn't buy it.
I'm nervous on Target too, and it reports tomorrow morning, and I would not want to be long this into the report either. I'm just nervous because retailers, we've seen multiple retailers warning. Now we get, Tim's look, from a quantitative perspective, not looking great here. Ducks kind of in a row. And again, anything can happen. To your point, maybe, your system didn't look like NVIDIA was going to pop, and it did. So it's not always right. Nothing's 100%. But I'm nervous on the Target earnings.
Well, I got the hardest one of the day, right? Okay. And this has been one that I tried. I think a lot of people have tried, probably in the chat. The natty gas bottom. When does it happen, Tim? When does it happen? Right now, people have told me in the chat that I could buy air better than I could buy natural gas.
So I don't know how many you track, Mitch. I've got 7 with heavy exposure to nat gas in my portfolio, and I'll take you to it. But this is, there's good and bad. The bad is, look at the supply side. This is 15 of the last 30 days. It's below 5. It's not great, and it's tipped over again. The supply side is better. 47% short, 48% short as of Friday. I don't love that. And I know EQT was the best performer last week. If you look at EQT, it's 7 out of 10 and rising, 48% short. 30-day trend is down. That's what that means. This will tell us a 30-day trend in the supply side. It's okay. But look at this weakness. I mean, you got ones, 1.8, 2.6, 3.4, down, 4.4 down. That's a 30-day trend. I don't love it. I'm not there yet. There are much better things to look at, such as cash.
Cash is not bad
king,
right now.
baby.
Right.
Cash is king.
Right.
I'm long cash. I'm long
Me
cash.
too.
I'll borrow some cash. All right. Like always, you guys can keep up with everything that Tim Quast does. And of course, check out Market Structure Edge for yourself. You guys can be running through all of this. Get your free trial. You can get up to a month just without even a credit card. And you guys can use the promo code, of course, Benzinga. Is it Zynga or is it Benzinga? I'm pretty sure
it's Benzinga, all
Benzinga.
caps. That gives you
All
a
cap,
monthly.
baby.
It doesn't work for a yearly. It works for a monthly. But monthly, that'll give you
Check it out.
$40 off. It's a very good deal. It's the best deal we have. Yeah.
Well, there you have it. Like always, Tim, we always glad to have you on. We took a look at all different types of the market. We'll definitely bring you back next week. Have a good one,
Look
Tim.
forward to it. You guys too. Have a good week.
All right, let's get back to the market. What are you seeing here? I was seeing that LNG. That looks interesting setup there, but let's go back to the market. Let's go to the SPY here. What are we seeing? We're seeing still a little push, almost 400. We just hit it. Just hit it here.
Yeah, you're right here up at resistance. I think.
Have we run too far this morning already?
I think we just go to the Joel Elconin. He's taught me so much is looking at daily candles. He's a daily candle trader. I think you go back to Thursday's high, 402.20. It's probably, you cut through 400 maybe, 402.20. I think you got resistance. I think you're selling into the rip. I think you're selling into the strength. Again, though, we're in this choppy market. So, as much as everybody was maybe bearish last week and it's getting ugly, then you got to start thinking about buying stocks here again. So just keep thinking about so much like this, not like this, not like this in this market. Think about the sideways waves, sideways action, because I think that's what we're going to see for the foreseeable future. I don't think we're going to get hammered unless we have some geopolitical risk. I don't see really any reasons for us to be gapping higher, but I do see reasons we could gap lower. So I'm still cautious, obviously long term, but trading sideways, selling rips, buying dips, taking opportunities there, but not getting married to anything.
Last one we got to talk about, of course, is the Tesla Dragon already getting some lift here this morning. There was some news out there that in the Giga Berlin, they've increased the Model Y output to 4,000, pretty much doubling the output in Giga Berlin in less than 6 months. And of course, they got their event on the 1st, right? 1st of March is the event. Don't miss that Tesla event. I'm pretty sure we'll stream it here on Benzinga. So if you guys want to check that out on Wednesday. What do you think about Tesla now? Does it get another run?
Holding up very well, and bulls are in full control as long as the stock stays above 187. We've had a significant pullback in the Qs. Tesla has not pulled back. We've had a significant pullback in the Qs. NVIDIA had pulled back a bit, but now obviously right back up here again. These are two stocks you're still watching from a growth perspective. There's been a significant pullback in a lot of these growth names. And you know what? I think actually as trades, you might be looking at buying some of these names, on the growth names on the pullbacks. Again, not marrying them, not investing in some of these growth names. Look at the Kathy portfolio there. She's come off significantly, not quite to the 50% retracement, but with NVIDIA and Tesla holding up as well as they are, and me still predicting the sideways action, I think a lot of these significant pullbacks we've had in some of our other names could actually be bought for trades. So I'm looking at some of these growth names on the pullbacks to actually buy.
We'll look at some of those names.
Short term, not investing in any of these things.
You got like Unity, Snow.
Yeah.
Some
of those Unity's held up a little. Actually, Unity, holy mackerel.
Yeah, look at that pullback.
That was earnings. And wow, I didn't realize it pulled that. So yeah, the 28.51. If I was long and trying to buy it long, I would lean on that low, probably going back to January the 19th to 28.51. But you've pulled back. That one's a little bit almost too ugly for me there. I cringe a little bit on that chart. But there's what are the other ones he said? He said Unity, Roblox,
the Snow.
Yeah, the Roblox 35. Like here's an interesting one. So obviously we had the gap up, and now we filled the gap. I mean, this is just classic fill the gap, and now maybe find some support where we gap from. So I kind of like that whole 35. Again, it kind of sucks now. It's 37.5. We would have talked about this on Thursday or Friday. The little double bottom, 35.81, 35.86. So, but right here, again, for trades, we've pulled back a bit. Maybe you get a little bit of, life here again, where everybody's talking doom and gloom now on CNBC. I'm starting to lean a little more bullish in the short term because, again, I don't think that we have an imminent catalyst to knock us down
Ooh,
either. Let's pull
Shopify
back.
down the 40s.
The bad earnings. The 40
Bad
is a big number,
earnings.
though. I had a friend on Twitter tweeting out to me and said, "What do you think of shop at 40?" And I was like, "It's a logical place for it to bounce." And here it is, 41.12. I mean, we filled the gap. We had the big fluff, and now we've pulled back here.
Nice
So
little
I don't
gap
mind the
fill.
Shopify. If you think you're in a sideways market, you're finding those old resistance levels as new support. And if I think we're going to an overall sideways market, I don't mind Shopify. I mean, people who are listening to the show would be surprised at me talking like this right now because I'm overall bearish. But I just think we've sold off quite a bit last week. So
I
now
agree.
I'm leaning a little bit long on some of my trades. I like the Shopify at 40. I think you could try to lean on that low at 39.87, and maybe you could get back up. Again, when they have bad earnings or they have disappointing, they come down. It takes something to really kickstart them back. It sometimes even takes an analyst move, a contrarian analyst to come in, which is rare. But technically speaking, the 40 is a level you would think that if I was short the stock, I would be covering, and you'd think that's a level that it could bounce at.
We'll see what happens with these types of names. If they're able to get the bounce, like always, you guys can keep up with all the action that we do on Benzinga right here. We're going to go to live trading. That's going to be coming up next. Any last words, Dennis, before we get out of here?
Chop.
Chop.
I think you got room, 402 SPY, and then maybe I'm lightening up. Again, just, buying dips, selling rips. I know I'm like a broken record here, but that's how you make money in a sideways market. It's not sitting around and waiting for the 50 or 100% gainers because they don't come.
Well, a lot of what we talked about last night was what we just kind of talked about with Dennis and Tim Quast about expectations and beliefs, right, in the market. You got to sometimes align those with the current environment. Right now, that's been kind of more of the take your money and run type of market. It hasn't been the, I'm just going to leave this runner on for the next 6 months and see what happens, because a lot of the times that's positions come back, especially when we're playing the chop, right? And so a lot of what I've seen is when you get those nice motions or like that whoosh in your direction, it kind of makes sense right now, at least in my sense and my trading, to take that profit and then just run. It's okay to reset up. What's not okay is to keep letting trades just make profits and give them right back, right? That's where it gets a little frustrating.
This is the type of market where if you're holding too long, those winners eventually become losers, really on both sides. If you're in a choppy market, you can be short and you're like, I'm making 5, 6, 7%. Then boom, it comes right back. And you're like, well, this doesn't make any sense. We're going into a recession. Why is my stock popping up? Because we're not there yet. It's timing and we're just chopping around, and we have the big battle between the bulls and the bears. So it's definitely feels like it's still the Steve Miller band market. Take the money and run.
Take the money and run. Have a good one, Dennis.
Go See you, money, Mitch. Go get him, buddy.
You got it. Yep. All right, Dennis is out of here, team. We're going to get you over to now, of course, live trading. That's coming up next. You don't got to go anywhere for that. Stick around right here. We'll get you guys over to some live trading action. Lord Ryan and I will lead you guys through, and we're going to keep pushing forward, team. On Wednesday, we'll be getting to an interesting interview on live trading, so stick around for that. I'll give you guys a little sneak preview if you come over to live trading. That's starting up. Now, I do want to tell you guys about the book club. We just wrapped up our first book, Trading in the Zone, right now. And you guys that haven't joined, I'll definitely throw up the link while I talk about the book club. But check it out. We just finished Trading in the Zone, our first book of the year. We're going to continue growing. Now we have some multiple options. We're also taking a look at Burn the Boats. I'll recommend this book for you guys out there. This is from, of course, Matt Higgins, Shark, CNBC Shark. Toss Plan B overboard and unleash your full potential. Burn the Boats just came out on February 14th. And we're also taking a look at potentially maybe the Pure Equity Plus plan. This is, of course, by Peter Tanis. Check it out if you want a multi-million-dollar retirement. Join our book club. We're going to be looking at all these, selecting the book this Wednesday for our next book. So you guys still have a chance to join. Hit that link below. Now to get you guys over to, of course, live trading action. Got to take a look at some of my swing trades. We'll see how that's going. And of course, don't miss, start swing trading today, 3 p.m. to 4 p.m. Eastern. Do this every single day where I take a look at my swing trades and, of course, bring on a guest to talk about some trade ideas that they're looking at. Of course, you guys don't want to miss this. This is where we take a look at the swing trading action. There's so many day trading shows out there, not many swing trading shows, and not many done live. So check us out, team, 3 p.m. to 4 p.m. I'll see you guys over there. Now to get to some live trading action. Let's see if we can find some trades. Even Tim Quast just mentioned one that's on my radar now, LNG. Let's take a look. Let's get over to live trading.